Fidelity offers 28 different index mutual funds, and in this video we're going to be debunking what are the best Fidelity index funds to invest in. Becoming a millionaire is entirely possible by just passively investing in low-fee index funds, and I'm going to prove it to you right now. We're going to take a look at the compound interest calculator here to show you how you can become a millionaire with a simple index fund strategy, but if you're already familiar with this, feel free to use the table of contents down below to skip ahead to the section on specific Fidelity index funds. But what we're looking at here is a compound interest calculator on the investor.gov website, and we're just going to do a couple of quick examples here showing you how a passive index fund investing strategy is the best approach out there for becoming a millionaire in the long run, leveraging the stock market. And of course, I don't expect you to just take my word here. Instead, let's take a look at what Warren Buffett has to say, arguably one of the greatest stock pickers of our time. Well, even Warren Buffett himself has said that investing in a low-fee S&P 500 index fund is the best approach out there for most investors. And he even went so far as to have a bet against 5 hedge funds, where he said that over a 10-year period, the S&P 500 alone, which we're going to explain what that is shortly, would outperform their actively managed portfolios. And take a look at this right here. The 5 funds had an average performance in that time period of 36.3% after fees, which are much higher with active management, and the S&P 500 returned 125.8%. And just to give you a visual example here, we're looking at the FinViz heat map of the S&P 500, because a lot of people think the S&P 500 is this boring investment for like your grandfather, but it's really not. And what a lot of people don't realize is this is a market value weighted index. What that means is the larger a company is in terms of their market value or market capitalization, the more weight they're going to carry in that index. So when you are investing in the S&P 500 these days, a lot of your money is going into Microsoft, as well as Apple, Google, Meta, Nvidia, Amazon, and smaller amounts of your money are going into things like industrials and companies maybe that may have done better in generations prior. So now let's jump back over to that compound interest calculator, and I'll just show you how you can become a millionaire with a simple strategy. And according to Investopedia, the average annualized return since adopting 500 stocks into the index in 1957 through the end of December 2023 comes in at 10.26%. So we're going to go ahead and use that figure for our calculation. Let's say you had an initial investment of $0 because you're just starting from scratch, but you want to invest $100 per month into the S&P 500, and let's say that you went ahead and did that for 10 years of your life. What would that look like? Well, if we click on the calculate button, we can see here that would grow to $19,300 and some change. Nothing too crazy, but it is, a decent amount of money to have set aside from just $100 per month. And if we look at the difference here between these lines, it shows us the contribution here was $12,000 and the total value is $19,000. So it's about $7,000 in gains from the market. Now, if we go ahead and change this to 25 years, you're going to see the magic of compound interest taking effect, and now you have a 6-figure portfolio. Let's go ahead and push out another 10 years to the 35-year mark now. And at this point, you would have $345,000 in that portfolio. So maybe you started at 20 and now you'd be 55 years old. But I want to add 10 more years now and go to the 45-year mark. And that would be the equivalent of starting as a 20-year-old. And then at 65, maybe you want to retire and start drawing from your investment portfolio. At that point, you're at $936,380. So you're just shy of $1 million. If we add another year or two, maybe going to like 47, for example, at that point, you'd be at $1.14 million. So what I love about compound interest is the longer you leave your money sitting there, earning that average return, the greater dollar value your portfolio grows because you have more money earning that return. And this exponential curve here is a perfect example of that. So over those 47 years, even though you only contributed $56,400, the portfolio has grown to a value of $1.14 million just from the average return of the S&P 500 over 47 years. Now, of course, that's a pretty long time, but if you wanted to do it quicker, all you'd have to do is increase your monthly contributions. Let's say instead you were ambitious and you had $500 per month to throw into index funds, and then let's say you did this over a 25-year period. Well, that would end up being a value here of $613,000 in just 25 years. And if we push that out to the 30-year mark, just like that, there's $1 million in 30 years. So maybe you started at 20, you invest aggressively, and you want to retire at 50. Well, that's how you do it. You do it with index funds. You don't do it with messing around with stock picking or anything like that. So now that we understand what the S&P 500 is and how this passive strategy can turn you into a millionaire, let's dive into some information about Fidelity. This is one of the big brokerage firms out there among names like Charles Schwab, Vanguard, TD Ameritrade, and E-Trade. And I actually did a separate video on Vanguard index funds as well. I'll put a card in the corner and a link down below if you want to check that out. But Vanguard and Fidelity are pretty much like the top tier here in terms of index funds, and there's not necessarily one that's better than the other. They're both really good, but they definitely are in direct competition with each other. In terms of assets under management, Fidelity comes in at an astounding $4.5 trillion. So just imagine the amount of compounding happening on all of that wealth, and it really blows your mind. Now, when you're looking at index funds, one of the most important things to be aware of, aside from just the composition of the portfolio, is that expense ratio, or how much money is being collected by the fund manager. Now, in the case of index funds, the expense ratio is going to be a lot lower than what you would pay with something like an actively managed mutual fund, because of the fact that instead of paying a team of managers to be changing the allocations in the portfolio, instead, it's just following a market index like the S&P 500. So there are still fund managers, but it's a much more passive approach, and that brings that cost down to almost nothing, or in the case of Fidelity, actually nothing. We're going to talk about these Fidelity Zero Index funds, which have no fees and no minimums shortly. But back to the expense ratio. Let's say you have two identical index funds tracking the S&P 500, and one has an expense ratio of 0.03%, meanwhile the other is 0.3%. While that might not sound like a lot, you're actually paying 10 times more fees investing in the same underlying asset. You're just doing it over here versus over there. Now, there's not normally that big of a difference in the fee, but you should be aware of it, especially when you consider the fact that this might be a multi-decade investment. Maybe you want to follow the earlier example I showed you and invest for 30 or 40 years. Well, just imagine the impact that that fee difference will have on your return over the long run. So that's why it's super important to just be aware of the vehicle that you're in terms of investments, because not all are created equally. Fidelity has done many things over the years that are innovative solutions for investors, and one of these has been the Fidelity Zero Index Funds. This is a collection of index funds with zero fees in terms of the expense ratio or transaction fees. In addition to that, zero minimum investment. So that's pretty unheard of. But just because they offer zero fee index funds does not mean that every fund out there that they offer is free to invest in. In fact, if we look at this example here, the Fidelity International Sustainability Index Fund, well, this has an expense ratio of 0.3%, which is actually on the higher side if you look at the options out there. Now, it's probably because there is a lot more active management going on with an index fund like that, but still, you should just be aware of it and look at the expense ratio for any particular fund that you choose to invest in. For the average retail investor out there like you and me, your best approach is to get low fee, diversified exposure to index funds that track both the S&P 500 and then, in addition to that, some type of bond fund. As you get older, it becomes more and more important to figure out that balance between stocks and bonds to make sure you're not taking on too much risk. Now, in your 20s, for example, it probably makes sense to have the majority, if not all of your money in equities or stocks. But as you get older, you don't want to have all of that downside potential there. So you begin putting your money into bonds as well and reallocating and changing those numbers over time, increasing the amount you're putting into bonds. Now, another thing you're going to come across is that Fidelity and other investment providers oftentimes offer both index funds and ETFs, or exchange traded funds. So let me go ahead and explain the difference now between Fidelity index funds and Fidelity ETFs. As mentioned before, ETFs are exchange-traded funds, which are basically index funds that are split up into millions of shares, and then those shares trade on the public stock exchanges just like a stock. So you can go out there and buy single shares or fractional shares these days of these ETFs, and it's just like buying a stock. The benefit here then is that you could invest in these Fidelity ETFs regardless of the brokerage firm that you're using. So maybe you're with Robinhood or Charles Schwab, for example. This would enable you to still invest in Fidelity ETFs. I'm also going to be doing a full tutorial on the Fidelity investment platform in the near future, so make sure you subscribe and hit the bell for notifications on when that comes out. One important consideration to make here, though, when looking at ETFs versus index funds is how the dividend reinvestment is handled. Because in most cases, when you have an ETF and the dividend is paid out on a quarterly basis, it's going to be paid out in cash and it's not automatically reinvested unless you elect to do so. Now, not all brokerages out there offer a DRIP or dividend reinvestment program. In the case of ones like Robinhood or Fidelity, things like that, they most likely do, but it's a setting that you have to enable on your own. And if you want to earn the maximum rate of return, in the earlier example I was showing you, that's assuming reinvestment of those dividends back into the issuing asset. That way it can earn more future dividends. With index funds, the dividends are often automatically reinvested back in, and that can be one benefit here if you want to leverage the Fidelity platform for your index fund investing. You might have more of a set it and forget it strategy, but you can also figure out how to reinvest the dividends with the ETFs. There just might be more settings that you have to go through with your current brokerage firm. Like I said, Robinhood, for example, offers an automated dividend reinvestment program. If you want to learn more about them, I just did a full Robinhood tutorial. I'll put a card up in the corner as well for that, as well as a link down in the description below. At this point, we've covered all the foundational stuff, so let's start looking at some actual Fidelity index funds. But real quick, guys, I have to mention here that I'm not a financial advisor, and this is not any sort of specific investment advice. This is not any type of recommendation on what to buy. Instead, it is for you to do further research upon. Let's go ahead and take a look at some of these Fidelity index funds now that are going to be some of the best options out there for your short list. The first one we're going to look at here is the Fidelity Zero Total Market Index Fund, and this is among the Fidelity index funds that come with no transaction fee, no minimum investment, and zero expense ratio. If we take a look here at the details on the return over the last year, this has had a 28.84% return, but that's been pretty crazy because the last year has been a great time in the market. So you wouldn't expect something like that to happen every single year. And if you look at the 5-year as well as the lifetime performance here of 14% and then about 12%, that is more like what we were talking about at the beginning with the average annualized return from the stock market. If you scroll down here, we can see the hypothetical growth of $10,000 invested in this fund over time. And one of my favorite things to look at here is the top holdings, because it's pretty crazy to see just how much of your money is going into these mega tech companies. So if you invested $100 in this particular index fund, about $6.30 goes right into Microsoft, about $5.70 goes into Apple, $3.20 goes into Nvidia, and so on. But it's crazy because these companies have become so valuable. Since it's a market value weighted index, they carry a much larger slice. If we scroll down further, we can get information about the top sector, and that is going to be information technology. 28% of your money is going into that category, and this is going to be mostly domestic or US exposure, coming in at 99.45%. Now, if we look at the composition tab, we can get more information on the other sectors that are represented here. As mentioned, information technology was the top, but we also have a lot of money going into financials as well as healthcare and consumer discretionary. And just to show you the fees here so you're aware, it's coming in at an expense ratio of 0, as it is one of those Fidelity Zero funds. The next one we're going to look at here is the Fidelity Zero International Index Fund. Now, what you will notice about this is that the average annualized return is lower, as the US stock market is often going to be the leading market in terms of the highest returns. But even so, over the last year, this has returned a little over 13%, and the lifetime return here is about 4.5%. If we look at the top 10 holdings here, we can see a lot of foreign companies here. The Taiwan Semiconductor Manufacturing Company, we see Nestle, as well as Samsung Electronics, the Toyota Motor Corp, Tencent. So a lot of names that many of us are familiar with. And if we look at the composition here, we can see that 99.81% of this fund is in international equities, with a small amount in domestic equities, 0.18%. So if you wanted to have some international exposure in your portfolio, you could incorporate this as part of your asset mix. Next up on the list here, we have the Fidelity 500 Index Fund. This is going to be comparable to your Vanguard S&P 500 Index Fund, and this here has an average return over the last year of 30.45%. And if we look at the last 10 years, it comes in at 12.69%, more in line with what we were looking at with the first example. Now, if you wanted to invest in the S&P 500, this is a very solid avenue for doing so. However, we have exited the Fidelity Zero territory, and at this point we are coming into some low expense ratios. This particular fund comes in here at 0.015% expense ratio, which is very low, but it should be noted just so you're aware. And since we're just looking at 500 companies in this case instead of a much larger basket, you're seeing even more concentration into the top names. So in this particular case, about 7.2% of all of the money that goes into this fund goes right into Microsoft, 6.6% goes into Apple, 3.7% goes into Nvidia, and so forth. And if we take a look at the composition here, this is 99.36% domestic equities or US companies. So it's, again, the 500 leading companies in the United States, giving you diversified exposure. 29.43% of your money goes into information technologies, about 13% in financials, 12.7% into healthcare, and about 10% going into consumer discretionary. The next fund we have here is the Fidelity Large Cap Growth Index Fund. So let's say, for example, you're a young person and you want to be more aggressive with the stock market. This has more of a focus on growth stocks, which are rapidly expanding and growing revenues. As a result of that, we can see the return has been much higher over the last year, coming in at 45.96%. However, just be aware of the fact that growth stocks are going to take more of a hit during a recessionary environment or something like that. So you are basically setting yourself up for more potential downside, even though there is more potential for upside. And the portfolio composition here is even more tech heavy. 12.15% of the money goes right into Microsoft, 11.16% goes into Apple, 6% into Nvidia, 5.74% into Amazon, and so forth. So if you wanted a tech-heavy portfolio, for example, as a young person, this might be an index fund for you to consider. And if we go up here and take a look at the composition, we're going to see that 44.26% of this entire portfolio is in information technologies. So you're heavy in tech with this particular fund, giving you a lot of upside potential, but it's also going to be more downside if we see a bear market. Now, as mentioned before, it's going to become more and more important to begin allocating your money into bonds and not just equities as you get older. So I wanted to include a bond fund on the list here as well. This is the Fidelity US Bond Index Fund, and this is going to be a much lower rate of return because the idea with bonds is just to preserve your wealth and outpace inflation, not so much looking to have the potential for upside, but also a lot of downside. So over the last year, that's a 3.3% return, and the 10-year performance here is at 1.41%. However, take a look at the yield here in this case, which is coming in at 4.41%, because bonds are mostly about the yield being paid out in those dividends and not so much returns being generated from the underlying value of the shares. And if we take a look here at the composition, we can see that 40% of this is in US Treasuries. We see 26% in corporate, and there's also some money in mortgage-backed securities. I don't see any municipal bonds represented here, but the three categories of bonds are going to be your municipal bonds, corporate bonds, and then US Treasuries. Environmentally conscious investing has become more and more popular, so I did want to include the Fidelity US Sustainability Index Fund for those looking to invest in companies that support sustainability for our planet. And it's pretty cool to see here that this has had a really solid return as well. Over the last year, just shy of 34%, and the lifetime return of this fund here is 14.35%, so I definitely wouldn't sleep on this one. It does have a little bit higher of an expense ratio at 0.11%, but it might be worth looking into for further research. If we look at the top holdings, it is similar to what we have seen in terms of Microsoft and Nvidia, but you're not seeing Apple, for example, represented here. As to why that is, I'm not sure. You know, it depends on what their ESG goals look like and that kind of thing. But it is a lot of your money going into Microsoft, Nvidia, Alphabet, Tesla, Eli Lilly, and then you have Visa, Johnson & Johnson, et cetera, et cetera. 30% of this roughly is in information technology. We can see that healthcare is the second biggest sector represented, followed by financials and then consumer discretionary. That's it for the index funds that I wanted to show you in this video. Of course, you could do further research on them using the Fidelity website, and I would encourage you to talk to your financial advisor about what is a good fit for your portfolio. But the last thing I want to cover here is that ETF that I mentioned earlier, and this is a brand new investment from Fidelity, the Fidelity Wise Origin Bitcoin Exchange Traded Fund. So instead of buying the index fund through the Fidelity platform, you can buy this as an ETF through any brokerage firm, and this gives you exposure to Bitcoin through an ETF. The expense ratio comes in here at 0.25%. However, there is some type of expense waiver. It looks like starting in 2024, August 2024, they're going to start charging a 0.25% expense ratio. But if you wanted to take advantage of that early, right now there is no expense ratio since it's a brand new fund. If we jump over here to the composition tab and scroll down, we can see that this is a 100% allocation into Bitcoin. So if, for example, you were looking to invest in Bitcoin, but maybe you weren't a fan of the traditional routes of crypto exchanges or cold wallets, this would be available through your current brokerage firm. And the benefit to this is this would give you that pass-through SIPC protection on your Bitcoin, which you wouldn't ordinarily have when you invest through something like a wallet. But at the end of the day here, I don't want you guys to be held back from what's called analysis paralysis. So your best strategy here is to just get started with something. Maybe it's a simple S&P 500 index fund, and then over time, as you continue learning, you may choose to build a more diversified portfolio. Like I said, I have an upcoming video about Fidelity. It's going to be a full step-by-step tutorial, so don't forget to subscribe and hit the bell for when that comes out. Lastly, I do have a book out there, From Side Hustle to Main Hustle to Millionaire, which is a step-by-step guide on how to get your very own side hustle off the ground. I became a millionaire myself by the age of 26, leveraging the internet and various digital side hustles. So if you're looking to get there a little bit quicker than an index fund approach, I would definitely recommend checking that out. You can get a copy at Barnes & Noble stores. It's also available on Amazon, and it's also at libraries across the United States. Thanks so much for tuning in, guys. You can click below to watch my video on Vanguard index funds, and I'll see you there.